gold really held up quite well into the Fed-induced selling this week. And while the NSFR-compliant silver market was able to be gamed well over $2 lower, rinsing out speculators in the process. So spot gold will continue on a short-term basis to evidence central bank and sovereign buying, no matter what the price. It doesn't matter what the price is. They don't care. But paper markets may seek to test the round number, which they did, which currently, which they have, and they've breached that round number. But guess who's taking the long side of this? Is the commercials who are basically looking at the obligations to deliver against these paper prices.
Andrew Maguire, a precious metals expert and founder of Goldmoney, recently appeared on Live from the Vault, where he discussed his perspective on the dangers of rehypothecated gold. Rehypothecation is the practice of lending out gold that has been deposited with a bank or other financial institution. According to Maguire, this practice has become prevalent in the gold market, where the same physical gold bars are being pledged as collateral for different purposes simultaneously. During the interview, he warned that this could lead to a situation where the actual physical gold available was significantly lower than the claims made on it, creating a potential disaster if multiple parties attempted to reclaim their gold at the same time. Andrew's comments shed light on a potential systemic risk in the gold market, emphasizing the need for increased transparency and accountability to avoid a potential hellish scenario. According to Andrew, the Federal Reserve's stance on gold serves as a significant catalyst for its bullish prospects. By maintaining a short position, the Fed inadvertently contributes to an upward pressure on gold prices. The reason behind this lies in the eventual necessity for the Fed to repurchase gold to close its position. Andrew further believes that the current volatile nature of the gold market is largely due to the uncertainties surrounding the Federal Reserve's position. Consequently, predicting the market's immediate reaction becomes a challenging task. However, Andrew maintains a positive long-term outlook for gold, emphasizing that the Fed's position should be regarded as a temporary setback. Now let's watch some clips from Andrew Maguire's interview with Live from the Vault. But before we do, please make sure to watch the entire video. Also, consider subscribing to our channel and turning on post notifications so you never miss an upload. Thanks and enjoy the video.
What are the actionable support levels? Now, if you're a stacker, the hell with it. It doesn't matter. Just buy. And obviously, that's not trading advice. That is simply convert as many as you're depreciating fiat worthless dollars, pounds, whatever, into obviously physical. And that's what this is about. It's about understanding why we do it and, what the whole reason behind it is. And so really, following the very bullish April monthly closes that you talked about, Shane, in both gold and silver, what we need to do is look under the covers as to why gold and silver performed so well last month inside, which was a battle which has really changed. And what we can then look at what really we need to look at going forward. Now, notwithstanding the last 15 months of unprecedented, extremely bullish central bank and sovereign physical gold accumulations, which has been serving to underpin and capitalize on paper market dips, we also identified two major paper market inflection points, which are ultimately bullish as they play out. So the first one is the trapped Fed. We'll deal with that first. And the second one is really the adoption of paper gold by a splinter group of speculators beginning to embrace gold as a first-tier asset class. As I say, start by looking at the mammoth in the room. This is an extremely wrong-footed kamikaze Fed trapped inside a self-induced, what I would consider to be a rehypothecated gold hell. Now, the elephant in the room is the Fed. So it's now exposed as the only global central bank that has failed to cover their extremely wrong-footed, bearish, naked short paper gold bets ahead of Basel III NSFR standards, formally reclassifying gold as a first-tier asset. And that was on the 1st of January. So now trapped, facing an impossible-to-hide race by other competing central banks and sovereigns into physical gold and unable to short cover more than they can induce speculators to sell or short sell, which is what we're seeing today, which is exactly what we're evidencing right now. And we'll look at these footprints shortly, but how do they get out of this predicament? I mean, the question is, for the third time in history, do they once again have to revalue Treasury gold, or do they print their way out? Now, either solution is going to rally the dollar-denominated gold price. Obviously, gold hasn't moved in price. It's just the amount of dollars, pounds, euros, whatever, that it takes to buy the same ounce. The 5,000 years of backtesting tells us that's correct. And as we know, the Fed does not hold any physical gold. It holds US Treasury gold certificates. Now, obviously, this is an inside arm's length agreement that currently insulates the Fed and it allows them to maintain monetary control without danger of political interference. Now, it insulates gold from its real price, though, and it keeps the power in the Fed's hands. But with gold now revalued as a first-tier asset, the Fed no longer has control of the physical gold price. And worse, there is empirical evidence they are sitting on a cesspit of rehypothecated gold reserves. Rehypothecated just means there are multiple ownership claims on each ounce.
Moving forward, Andrew Maguire also expects that the Fed reevaluating gold will have a number of consequences, both positive and negative. He believes that a reevaluation of the gold's price will have positive effects, such as a significant increase in its value. The current valuation by the Fed is considered artificially low, and a reassessment will align the price with its actual worth. Furthermore, the reevaluation will generate higher demand for gold from investors who perceive it as a more appealing investment option with a more accurate valuation. Nevertheless, Maguire also anticipates some negative consequences, including increased volatility in the gold market. If gold were to be reevaluated at $6,000 an ounce, it would have a significant impact on the silver market. Silver is often seen as a hedge against inflation, and a rise in the price of gold would likely lead to a rise in the price of silver. Andrew Maguire believes that the rise in the price of gold would make silver more attractive to investors as a hedge against inflation and a more affordable way to get exposure to the precious metals market. Let's get back to the interview.
Historically, gold's collateralization of US foreign obligations has reached historic lows, far worse than when we drew attention to this back in March 2020. And you know what happened in March 2020. And given that the Sino-Russian BRICS plus nations are increasingly backing their currencies with gold and hard commodity baskets linked to gold, we see this as one of the main objectives that actually Basel III was forced to address. Now, if the Fed does not move to also at least partly back the dollar with gold, the US dollar will ultimately collapse. Obviously, if other currencies are backing theirs with gold, it's going to devalue greatly against them. And this has been the case as every single unbacked fiat currency in history has collapsed against benchmark gold. Now, we see this as the primary reason that the dollar-denominated gold must also be revalued, or it'll be drained to zero. The problem is, without an audit, how much of this 8,133 tons is actually physically available to deliver? Now, if we accept that the 8,133 tons of unaudited, I can't get over that word, unaudited Fed gold, if we accept that at face value, okay, let's do that for a minute, then the current ratio of gold to foreign debts outstanding is around 5%. Now, this ratio is so far below the 20 to 40% historical average, and based upon the move to reclassify physical gold as a first-year asset, the BIS likely expects this ratio to revert to its historical average. So who's out of kilter here? The best case assessment assumes unaudited US gold reserves. Let's assume they're not rehypothecated, burdened with multiple ownership claims on them. But if they are, a haircut would have to be imposed. So this ratio could be anywhere between 0 to 5%. And for all we know, here. And we wonder why no audit's been allowed. Honestly, it starts to stink, doesn't it? So this is where the numbers emerge. Now, even taken at face value, restoring a 20 to 40% ratio of gold to foreign debts outstanding from current levels put gold at somewhere between $6,000 to $12,000 per ounce. However, the last time the US dollar was questioned was in 1980. And at that point there, when the foreign held treasuries of the US government were 140% collateralized by gold, well, at 1980 levels, it puts gold at over $40,000 an ounce. Look, I'm just saying, guys, okay, at $40,000 an ounce, I assume there will be plenty of sellers. So let's just discount this for now. But just be aware, these are the numbers. Monetary silver. The gold-silver cross is currently at around, goodness me, over 80 to 1 at the moment. That's 80 ounces of silver to buy 1 ounce of gold. Actually, it's higher than that, but never mind. Just use a number like that. Even if we don't adjust this to more realistic levels, it still puts silver at a minimum of $75 to $150 an ounce. However, as gold breaks loose of its unallocated collar, silver will too. Now, put a short squeeze on silver, and the historical 16 to 1 ratio becomes magnetic, suggesting a minimum silver price of $375. Again, just saying, these are facts. Look, let's not discount these targets. We are encountering unprecedented circumstances. 50 years of paper gold dilution has arrived at a physical wall, and a real equitable gold price is going to emerge, like it or lump it, Fed.
Gold and silver are often seen as a hedge against inflation because their prices tend to rise when the value of fiat currencies falls. This is because gold and silver are precious metals that have been used as a form of currency for centuries. If inflation continues to rise, it could lead to higher prices for gold and silver. If the price of gold continues to rise, it could lead to increased rehypothecation. This is because banks and other financial institutions will be more willing to lend out gold that is increasing in value. What do you think the future holds for rehypothecated gold and silver? Please leave your comments and observations in the comment section below. Also, be sure to like this video, subscribe to the channel, and enable notifications to stay up to date on our latest videos on silver, gold, and copper. Thanks for watching.